Hi everybody, this is lecture 1 week 4. Okay, in this lecture, this is still topic 2 in this course. You can check in the course outline. So in the previous lecture, you have started to learn about accounting process. Accounting process means the thing that you have to do when you want to make accounting record. So in the previous lecture, I have told you that if you want to do an accounting record for a business, you have to follow accounting cycle. Accounting cycle contains the steps that you have to do when you want to make accounting record for a business. So just to refresh your memory, there are 8 steps in the accounting cycle. The first one is analysis. Analysis means when a transaction happen, you have to know the type of the transaction, and then you have to know what is the effect of the transaction on the accounting equation, and then you have to know the amount related to the transaction. That is the step 1. Step 2 in the accounting cycle is record the transaction in the journal. And then step 3, you have to do ledger. Step 4, you have to do or prepare a trial balance. Step 5, you have to do adjusting entries. Step 6, you have to prepare an adjusted trial balance. Step 7, you have to prepare the financial statement. Step 8, you have to do closing entries. So last week, in the previous lecture, you have learned about step 1, how to do the analysis. This week, in this lecture, you will learn about step 2, which is record the transactions in the journal. Okay, let's see. Okay, remember this. Journal is the book of original entry. In other words, journal is the first book that we use in accounting. So when you want to make accounting record for a business, first you have to do the step 1 analysis, and then you have to record the transaction in a book called journal. Okay, see here in this slide. Record the results of the transaction in a journal. Journalizing provides a chronological record of all business activities. Okay, remember this. Journal is the first book that we use in accounting, and in the journal you record everything according to the time it happens. That's why it said a chronological record. You record the transaction according to the time when it happens. Okay, so when you want to record the transaction in the journal, the first thing that you have to know is the rule of debit and credit. In accounting, when we record the transaction, we have to use this rule of debit and credit. Okay, just remember this. Debit means left. Credit means right. When we in accounting, when we say that you have to record in the debit side, it means that you have to record the transaction in the left side. When we say that when a person says that you have to credit an account, it means that you have to record the transaction in the right side. Okay, this is the rule of debit and credit. So this rule is related to the accounting equation. Remember, in accounting we have accounting equation. So the equation that we have is assets always equal to liabilities plus owner's equity. So this one you have to memorize. Okay, so assets. So for assets, an increase in asset, you have to record in the debit side. If there is a decrease in asset, you have to record in the credit or in the right side of an account. Okay, for liabilities, it is the opposite of asset. An increase in a liability, you have to credit. A decrease in liability, you have to debit or record in the left side. So for honest equity, it is same like the liabilities. An increase in equity, you have to credit. A decrease in liability, you have to debit. Okay, it's not very difficult, but you have to memorize this. For asset, if asset increase, you have to debit. If asset decrease, you have to credit. For liability, an increase in liability, you have to credit. A decrease in liability, you have to debit. For honest equity, an increase in honest equity, you have to credit. A decrease in honest equity, you have to debit. Okay. Okay, so just remember this. Okay, I have explained about the thing that shown in the yellow boxes there. Okay, this is the expanded rule of debit and credit. So remember, I have told you before, honest equity is related to 4 accounts: capital, withdrawal, revenue, and expenses. So for capital, an increase in capital, you have to credit. And then for withdrawal, an increase in withdrawal, you have to debit. For revenue, an increase in revenue, you have to credit. And then for expenses, an increase in expenses, expense, you have to debit. This thing, you have to memorize this, because it is the rule of debit and credit. You just follow the rule. Okay, here you can see that expenses increase, you debit. Revenue increase, you credit. Okay. Okay, this one. Before you can do the journal entry, you have to know the names of the typical names of accounts that we use in or for a sole proprietorship service business. So let's see here. Remember about assets? Assets are resources owned by a business. So the typical assets accounts are cash, account receivable, inventory, and supplies. Okay, everybody knows about cash. And then account receivable is something like this. If you have a business and then a customer owe your business, or you sell something in credit, the customer will pay in the future. That amount that the customer owe your business has to be recorded in an account called account receivable. And then inventory. So for a service business, there is no inventory. But for a service business, you have supplies. The example of supplies is like this. Let's say you have a laundry shop. So a laundry shop does not sell anything, but a laundry shop provides laundry services. So when the laundry shop provides the laundry services, the shop will use detergents, softeners, etc. These things in accounting we call them supplies. So let's say one day you have a laundry business, and then your business purchase detergents from suppliers. you have to record in an account called account supplies. Okay, then that are current assets. Remember about the what is the definition for current assets. And then for non-current assets, if you have a business, you will have non-current assets. So the typical examples of non-current assets are land, building, furniture, equipment, motor vehicle, etc. Okay, and then current liabilities. Remember liabilities? Liabilities are obligations, something that a business has to pay in the future. So the typical example for current liabilities are account payable. Account payable is something like this. You have a business, your business purchase something from a supplier, but your business will pay in the future. That amount that your business has to pay supplier in the future has to be recorded in an account called account payable. Salaries payable is the second example. Salaries payable is something like this. You have one worker, but you still do not pay the worker yet. So the amount that you owe to the worker has to be recorded in the account of salaries payable. Overdraft and interest payable. Overdraft is something like this. Overdraft is a short-term loan provided by banks. If you have a business, you can apply for overdraft. That is something that your business has to pay in the future, so it is a liability. Interest payable. Interest payable is something like this. You have a business, you borrow money from bank or a financial institution, then you have to pay interest, but you do not pay yet, so you have to record the amount in an account called account interest payable, something that your business has to pay in the future. So the typical example of a long-term liability is long-term loan. You have a business, you borrow money from bank, you have to pay back in 5 years, for example. So that one is a bank loan. You have to record in an account called bank loan. In accounting, you have to record it in an account called bank loan. So that bank loan is a long-term liability because it is more than 1 year. Okay, equity. Equity is related to, like I said earlier, 4 accounts. The first one is capital. Capital is the amount contributed by the owner of the business into the business. Let's say you started a laundry business, you put $30,000 cash into the business from your own pocket. You take your personal cash saving, $30,000, you start the business. So that $30,000 in accounting, we call it capital. Retained earnings is the profit made by the business after the business has operated, let's say for 1 year or 2 years or 3 years. The profit made by the business is called or recorded in an account called retained earnings. And then another account related to equity is withdrawal. Okay, withdrawal is something like this. It is not written in this note, but you have to aware. There is an account called withdrawal. Withdrawal is an account where you record a situation like this. You have a business. You have a laundry business, and one day, let's say something happened, you need cash urgently, you take $1,000 from your business. So when you take $1,000 from your business, for that situation, you have to, in accounting, you have to record it in an account called withdrawal account. And then another account related to equity is revenue. In this course, the focus is on a service business. So for a service business, there is no sales, but the business provides services. So for a service business, when the service business got payment, or when the service business has provided a service to a customer, then the business has to record the proceeds in an account called revenue account or service revenue account. Let's say you have a laundry business and today a customer come and you provide laundry service to this customer, and then the value of the service is $50. So in accounting, you have to record the $50 in an account called service revenue account or revenue account. And then expenses. Okay, remember this, expenses are related to equity. The typical expenses related to a service business are this, like you can see in the slide. Salaries. When you have a laundry business, for example, you will have several workers to do works in the shop, so you have to pay salaries. So the salaries are an example of expense. Rental, maybe you rent the building, the laundry shop building, so you have every month you have to pay rental. So rental is an example of an expense. Advertising also is an expense. You have a laundry shop, you want to advertise your shop in the newspaper, for example, or in you want to advertise in local radio or local TV station or anything. So you have to pay the advertising, the amount that you pay for the advertising, you have to record it in account advertising expense. Transportation, utilities, and accounting fees. Utilities are things like water. You have to pay water, electricity, telephone, internet, every month. In accounting, everything like that you have to record in an account called utilities expense account. And then remember this, if you have a business, maybe you hire somebody to make accounting record for your business. You are the owner of the business. You are too busy, you are very busy managing the business, so you don't have time to do accounting record. You hire somebody. The amount that you pay to that person is an expense. You can record that amount in an account called accounting fees expense. If you do the accounting record by yourself, maybe you do not have to record it in this expense account. Okay, so these are common names of accounts. In accounting, when you want to record a transaction, you have to record in several accounts maybe. So these are the common names, the common account names that you will use in accounting. So back to the journal. Okay, so journal, remember I have told you earlier, journal is the first book that we use in accounting. So there are many types of journal. At least there are some most textbook explain that there are at least 7 type of journal. Cash receipt journal, cash payment journal, sales journal, sales return journal, purchase journal, purchase return journal, and then the last one is called general journal. So in this course, to make it simple and to make it easy for everybody, we will use only one journal, one type of journal. It is called general journal. In this course, every transaction when a transaction, every transaction that happen related to a business, you have to record it, or you have to know how to record it in the general journal. You can check in the textbook the format of other types of journal, but here in this lecture notes, I will focus on general journal only. Okay, so this is the format of the general journal. See in the yellow box. First, you have to write the date when the transaction happened, and then the next thing is in the column 2, you have to show the debit entry account with the amount related to the entry. And the second thing is you have to show the credit entry account with the amount related to the entry. And then at the bottom of the journal entry, you have to show the explanation. Okay, so let's see the example. There are several examples here. Okay, example 1. Remember, I have told you before, when you want to make accounting record for a business, the first thing that you have to follow the accounting cycle. So there are 8 steps in the accounting cycle. The first step is the analysis. The second step is the thing that you learn now. You have to record the transaction in the journal. Okay, see here. There is a business and then there is a transaction. So see here. This transaction is like this. Supplies purchased for 250 are purchased on account. So the thing that happened is the business purchased supplies, $250 supplies, and it is purchased on account. On account means the business purchased the supplies today but will pay later. So, and then the question asks you, prepare the correct journal entry. What do we mean by purchase on account? So I have explained that. So, like I said earlier, what is the first step? You have to analyze. And then the second step, you can record in the journal. So, we analyze this transaction first. When you analyze, you have to know the type of the transaction. So, for this transaction, the type of the transaction is purchase of supplies. And then, what is the effect of that on the accounting equation? Okay, this is still the analysis. The accounting equation is asset equal to liability plus equity. So remember this, when a business purchase supplies, the thing that happened is asset supplies increase. Remember, supplies asset. And then for this transaction, at the same time, liability increase. Because why liability increases? Because the business purchased on account. The business purchased today but will pay later. So the effect of this transaction on the accounting equation is asset supplies increase and liability account payable increase. The amount is 250. Okay, now you have done the first step in the accounting cycle. You have analyzed the transaction. Now the second thing after you to do after the analysis is to record that in the journal. So how to record that in the journal? So to record that in the journal, remember you have to follow the rule of debit and credit. So like I said earlier before, this transaction, the first effect of this transaction is asset increases, 250. So remember, rule of debit and credit. When asset increase, you have to debit or credit. The asset is supplies. Asset increases, you have to debit. So in the journal entry, see here, January 1 is the date. Asset increases, so you debit the asset. The name of the account is supplies. So debit supplies, the amount is 250. The second effect of the transaction on the accounting equation is liability, which is the account payable, increase $250. So you check the rule of debit and credit. when a liability increases, you have to credit. So the second entry that you have to write in the journal is credit account payable 250. And then the explanation is purchase supplies on account. Okay, let's see the second example. Okay, the second example is like this. A transaction happened. There is a business, a transaction happened. A check for $1,000 is received in payment for services rendered. So make the correct journal entry. So you know when a transaction happened, if you want to do the journal entry, you have to do the first step first. The first step is the analysis. So now, what is the type of the transaction here? The type of transaction, the type of the transaction is the business receive $1,000 payment for services that the business has provided. Okay, the second thing, what is the effect of this transaction on accounting equation? So when a business receive $1,000 cash, the first thing that happened is asset cash increases by $1,000. That's the first thing. And the second thing is when a business receive $1,000 from a customer, there is no effect on liability, but there is an effect on the account, owner's equity account. The owner's equity account that is affected is the revenue. When the business provide services to a customer, the revenue will increase. So the first effect is asset cash increase $1,000. The second effect is under the owner's equity, the account revenue increases by $1,000. Okay, so what is how to do the journal entry? So you remember, asset cash increase 1,000, debit or credit? Okay, according to the rule of debit and credit, when asset increases, you debit. So here you can see the date is February 1st. You debit account asset cash 1,000. And then the second effect is, I have told you, revenue increases 1,000. So you check the rule of debit and credit. When revenue increases, you have to credit. So in the journal, you have to show that credit account service revenue 1,000. So the explanation for the account for the journal entry is receive cash for services. Okay, example number 3, journal entry. The business provides services to a customer on account for 750. So the thing that happened is like this. The business has provided services to a customer. Let's say the date is today. And then, but the customer will pay later. The amount related is 750. So the question, you have to show the journal entry. The general journal entry. So what is the thing that you have to do first? You have to analyze the transaction first. So provide services to a customer on account 750. So when a business provides services to a customer, the business has to record the revenue, because you remember the rule, the assumption that you have learned before, the revenue recognition principle. A business has to record revenue when it happened. So when the business provides services, then the business has to record the revenue. So for this transaction, the first thing that the first effect of this transaction on the accounting equation is revenue increases. Revenue increases 750, but the customer will pay later. So the second effect of this transaction on the accounting equation is asset account receivable increases by 750. Okay, now you know that there are two effects. First, revenue increases 750. Second, asset account receivable increases by 750. So how to do the record? Okay, when the account receivable asset increases 750, you have to debit the account. So debit, the date is March 1st, and then the journal entry is debit account receivable 750. And then when revenue increases, you can check the rule of debit and credit. When revenue increases, you have to credit the account revenue. So the second entry here is credit service revenue 750. The type of the transaction is provide services on account. Okay, these are three examples of journal entry. So the journal record will look like this. In the general journal book, the record will look like this. So you can see there. The first transaction is on the January 1st, and then February 1st, and March 1st. So like you have seen in the previous slide, in the journal, the record is according to the time the transaction happened. It is in a chronological order. Okay, so these are the things that happen when a transaction happen. The person who prepared the account or make the account has to do the first step in the account, and in the accounting cycle, the person has to analyze the transaction, and then the second step is to record in the journal every day. And then at the end of the year, every business has to close their account. So every day when the transaction happen, you have to record all the transaction, and you have to analyze and record the transaction in the journal every day. At the end of the year, when the business has to close its account, you have to stop. Let's say 31st December 2020, then you have to stop recording the transaction in the journal. Okay, you stop recording transaction in the journal, and then you have to do the step 3 in the accounting cycle, which is posting journal entries to the ledger. Okay, ledger is the second book that we use in accounting. Journal is the first book, and then ledger is the second book. In the ledger, in the book called ledger, there are many accounts, and these accounts are called T accounts. Why we call it T accounts? Because it looks like the capital letter T. Okay, T account will look like this. The name of the account, you have to write the name of the account on the top of the T, and then in the left side of the T account, we call it the debit side, and then the right side of the T account is called the credit side. Okay, just to say it again, ledger is another book that we use in accounting. In the ledger, there are many accounts that we call it T accounts. Okay. In the earlier pages of the ledger, you will have something like contents of the book. Okay, that contents of the book in accounting we call it chart of accounts. This chart of accounts lists all the name of the accounts that will appear in the ledger with the codes related to each account. For example, here this is an example of chart of account. So imagine ledger is like a book. At the earlier pages of the book, there is a chart of account. Okay, chart of account lists all the name of the accounts in the book, in the ledger book, with the code. For example, here for current asset, cash is given 101. The code is 101. 105 is for account receivable. 107 is for inventory or supplies. 151 is land. 152 is building, and the list goes on. There are lists for the codes. There are code for honest equity accounts, etc. Okay. Okay, so for step number 3, remember I have told you when you do the step number 2, which is you have to record the transaction in the journal. Every day when the transaction happen, you record everything in the journal. At the end of the year, you stop, and then you transfer all the journal entries into the ledger. Okay, I will show you how to do that later when I record a sample question or sample scenario how to record transaction in the journal and ledger. But at this stage, you have to know that in the ledger there are many T accounts. So and then after you have transferred all the journal entries into the ledger, you have to close the account, the T account, and you have to calculate balances for all accounts in the ledger. You close the account and you calculate balances for all accounts in the ledger. Okay, after you have calculated all the balances of the accounts in the ledger, you have to do the step number 4 in the accounting cycle, which is to prepare a trial balance for the business. Okay, a trial balance is a list of all accounts with their balances. Okay, the format of a trial balance is like this. This is an example of a trial balance, supposed to be December 2019. Okay, so you can see here. Remember the definition. A trial balance is a list of all accounts with their balances. So you can see in the first column in the trial balance is the list, the name of all accounts. These accounts are coming from the ledger. So you list all the accounts, the name of the accounts here, and then also you have to list all the balances. Some accounts will have debit balances, and some accounts will have credit balances. When you prepare trial balance, the total in the debit side supposed to equal to total in the credit side. Like this example, the total in the debit side is 1,123. The total in the credit side also 1,123. If you see the total in the debit side equal to the total in the credit side, then most of the time it shows that the recording process that you have done in step 1 and step 2 and step 3 are correct. But if you see that the total in the debit side does not equal to the total in the credit side, then you know there is something wrong in step 1 or step 2 or step 3 of the accounting cycle that you have done before. Okay, you will I will show you how to prepare this trial balance, how to prepare a trial balance later when when I show you a sample question or sample scenario. At this stage, you have to know that this is the format of a trial balance. The main purpose of preparing a trial balance is to check whether the recording process done in the step 1, step 2, and step 3 are correct or not. Okay, this is the sample question. I will prepare a video for this sample question. This sample question, when you see for this sample question, you will see that you will see how to do the first 4 steps in the accounting cycle, which is to do the analysis, and then to record the transaction in the journal, and then to do or prepare ledger, and then to prepare a trial balance. You will see all this in another video. So I have explained the step 1, step 2, step 3, and step 4 of the accounting cycle. Okay, just the thing that I have explained earlier, is related to the process of making accounting record manually. Now, you can do accounting record using software, computer software. If you use computer software, the process is a bit easier. You just enter all the transaction and the amount related to the transaction. The software will process the data. The software will enter the data to the journal, and then transfer the journal entries to the ledger, and then the software also can prepare a trial balance. So let's see. Describe how technology has affected the first 3 steps of the accounting cycle. Let's see. The good thing about the good thing about using computer software to do accounting record like this. The first one is large amount of information can be quickly processed without error. Maybe most of the time without error. So if you use manual way of recording the all the accounting record, it takes time. But if you use software, you can do it quicker than manual recording. And then more documents can be produced than humanly possible in the same amount of time. Also, the software is very efficient. You enter the data, and then the software can generate documents. The software can generate invoice, receipts, etc. quickly. Common tasks can be automated for increased efficiency. So so that is the advantages. This is one of the advantage of using software. Things can be done very quickly. But there are several disadvantages. The first one is computer hardware and software require human judgment and input. So just always remember, the software is a tool only. A person need to do judgment and to do data entry. Second thing is garbage in, garbage out. It means that even though the software is very good, if you put wrong data, you will get wrong reports, and you will get wrong ledger and trial balance and everything. Okay, so garbage in, garbage out. You enter wrong data, then everything will go wrong. And then number 3, once an error is identified, fixing the problem may require many adjustments. So this is one major disadvantage of using software to do accounting record. If you do an error, then very difficult for you to check the error because everything is recorded digitally, and when you have detected the error, and then it takes time to do all the adjustments or corrections. But if you record, you do the accounting record manually, maybe it is easier to find the error and to do the correction, maybe, because everything is recorded in books, so you can check one by one and you can identify which one is the error, and then you can do correction very quicker compared to do correction in digital record. Okay, so this is the end of the lecture 1 for week 4, isn't it? So like I said earlier, I will record another video to show you how to do the analysis, the journal entry, the ledger and trial balance using the sample question that I have provided in this lecture notes. Thank you very much. You just write your name and metric number in the comment section. I will take it as the attendance. And then for students who have not subscribed my channel yet, please do so, because it make it easier for you to see my future videos.